Welcome to this edition of State of the Economy. Today we have as our guest Dr. Arvind Virmani, former Chief Economic Advisor at the Finance Ministry and also India's Executive Director at the IMF. Welcome to the show, Dr. Virmani. Everybody in India is really concerned about the manner in which international capital flows are today affecting the currency, not just the Indian currency, the currencies of other emerging economies like Brazil, Indonesia, Turkey, South Africa. Now, you've been at the IMF as Executive Director representing India. You have studied how these capital flows impact currencies and eventually the real economy. Could you just give us, in simple terms, an idea of what is really going on?
So, we have to wind back to what is called QE2 and QE3 in the US.
Yeah.
Now, basically, the QE, quantitative easing so-called, which was an expansion of the money supply in traditional terms.
The dollar printing by the US, right?
Yes,
Yeah.
but in the West, in a developed market, they switched over to using interest rate interventions to control the monetary loosening and tightening. But
This is after the 2008 crisis, right?
No, before the crisis, for the last 10 to 15 years, they had been using short-term interest rate, the Federal Reserve, which is the equivalent of our RBI, to manage the monetary policy.
Okay.
Now, when the global financial crisis occurred, the real interest rates went down to zero. So just moving interest rates down was not feasible, because the crisis was so huge. They had to find a new way. And the new way was actually the traditional way in which countries like India, less developed capital markets, have been doing it traditionally, which is to try to affect the money supply directly. So they called the fancy name quantitative easing, which we used to call monetary expansion and monetary contraction.
Yeah, so they start pushing more
dollars into the system, into the economy, instead of trying to lower the interest rate. Normally, it should have the same effect if everything else is the same, right? That's how we used to look at it in India. But the question is, what will work? So in a situation of financial collapse, global financial crisis, interest rate instruments didn't work at all.
Okay.
Because you had already reached a zero level, so it's not possible to go further down.
So you push more money into the system.
So you push more money into the system.
Yeah, and if I'm not mistaken, there's a figure which I saw in a research report, which said that before the crisis, 2008 crisis, the United States, the Federal Reserve balance sheet was $850 or $870 billion.
Absolutely
dollars,
right.
And today it is $3 trillion.
That's right.
So that means they pushed about $2 trillion in the last 5 years into the global system, right?
Very correct. So that is the method by which they push things into the system. So the Federal Reserve buys various assets like government securities, etc. But it may also buy other instruments or other financial assets to inject this money, depending on, again, we need not get into the complications. So the QE1 was widely welcomed. When QE2 and then QE3 came, I had questioned, we had actually raised this issue in discussing
while you were at the IMF.
I was at the IMF as executive director.
I remember you telling me that the G20 countries...
I was actually the first, and the question we raised was purely, clearly US, like any other country, has the right to have its own monetary policy. But what we had questioned was whether it was actually having any effect on the US economy and having more effect on the globe. That's why we connect, right?
In terms of inflation.
That's right. We'll explain that. So what was the effect? It was clearly, so the effect on the US economy was quite unclear. But what we could see was this surge of capital flows outside and the effect on commodity prices. So that is why we were raising. We were just saying study this and see what can happen, what problems it...
So was it studied by the IMF?
Yes, there were studies by World Bank, IMF and others. Was that this particularly QE3 had led to outflow of capital to the emerging markets. But the interesting thing was it didn't go to all the emerging markets, it went mainly to 8 emerging economies. So the question was why, right?
Okay.
So the answer...
You're talking about QE3 or all QE1,
we are talking
QE2?
more from QE2, QE3 mostly.
QE2,
but even QE2 to a smaller extent. more in
They
the
went
line of
to,
Q.
you're saying they went largely to 8 emerging.
Largely to 8 emerging market economies. And so the question was, why only these 8? Well, the reason is because
India was one of them, obviously.
India was one of them. So these economies were ones which had better capital markets and stronger emerging market economies. Strong doesn't mean strong compared to the developed countries, but they had open capital accounts, they had relatively better developed financial markets, and one of these obviously was India. The others were Korea, Turkey, etc., right? Brazil, and so on, which had open markets. Russia, relatively closed market, but Russia also. China has completely closed market, so not much capital flows into China. So the effect of that capital flow surge, basically from around 2008 onwards, was to lead to an appreciation of the rupee. And this is where what I told you, we had experienced that. I had seen this, and that's why I could talk confidently in the IMF. Was I had dealt with these things as chief economic advisor in 2007-8 before QE3.
So Dr. Virmani, what you're saying is, as more capital flows came into these emerging economies, the currencies here tended to appreciate.
That's right.
Because of increased dollar supply, right?
So, right. So there are two effects, right? One is, as the dollar comes in, unless the effect is exactly that, because the supply of dollars goes up, so the rupee tends to appreciate. Okay. So that would tend to
and now the reverse seems to be happening.
That's right.
As the flow,
right.
As the same capital flows back into its parent country, the rupee would tend to depreciate.
That's right. So exactly the reverse is happening. But in the meanwhile, many other things happen which we can get into. But this inflow and outflow, we know from experience that you get these surges and so-called sudden stops. Okay. And so I had actually tried to work out a way. I wrote a paper.
Can we, Dr. Virmani, we'll discuss the whole dynamics of inflows and outflows, but after a small break. Please don't go away and stay with us.
Actually, what we did do was to auction a small part of it. So this recommendation was partly accepted actually, and we are probably the first country which auctions some of this debt.
Welcome back to State of the Economy. We are having a conversation with Dr. Arvind Virmani, who is explaining to us the impact of capital inflows and outflows on the Indian currency as also the Indian economy. Dr. Virmani, you were talking about how after the 2008 crisis, America, the Federal Reserve, pumped in huge amounts of dollars in the form of QE1, QE2, QE3, and 8 emerging economies were recipients of these dollars. As a result, the currencies here tended to appreciate, and now the reverse flow will create the opposite effect. The currencies are depreciating, but as you said, you were going to say something about how this process is to be managed by these emerging economies. Now, what is the lesson that you learned when you were in IMF and now?
So, the lesson actually I learned before I went to the IMF, because we had the capital flow surge starting in 2006-2007. So, I actually had to deal with it when I was Chief Economic Advisor, and I wrote a paper which was later published in an international journal. And the basic idea was very simple. What I said, the traditional way of dealing with these surges and inflow surge and outflow was to try and stop the outflow when it occurred. And that's the time when the economy is weakest and has lots of negative effects. So what I said is turn it around, try to slow down the inflow so that you have less problem when it goes out. Okay. So I worked out a method which was basically an efficient way of slowing down inflows.
If I put it very simply, Dr. Virmani, what you're saying that when a flood of water comes, you try to restrict the water so the outflow is not as violent as the inflow.
That's right. That's absolutely. That's the simple. It's exactly that actually.
Yeah. And then how do you check the inflows?
Now inflows. This was the thing about this paper, which was actually widely downloaded and reprinted in a book later. The idea I had was that you should auction the debt. People bring in and come into the market, so auction their right to enter the market, and therefore there will be a price. So if there's a flood, the price will jump, and that will keep the thing out. when the flood subsides, the price will go down and it will encourage more flows. So it will even out the flows rather than having a sudden surge and a sudden stop.
So basically you're talking about putting a price to big inflows, right?
Yeah, to slow down inflows.
Slow down inflows, yeah.
And to encourage it automatically without doing anything
So that would have,
when it starts to
that,
outflow.
That would have meant if Indian corporates at that time wanted
That's
to
right. Would have been more
borrow
expensive.
big, you should have auctioned the debt.
Yes. And so actually what we did do was to auction a small part of it. So this recommendation was partly accepted actually.
Okay.
And we are probably the first country which auctions some of this debt, but that's not enough. My recommendation, it has to be across the board, otherwise you just get substitution.
But Dr. Virmani, my experience tells me that many corporates actually had opposed that move because they wanted at that time unlimited cheap funds.
Right. So they always, the borrower, when he's getting cheap credit, always wants it. But the government also played a role because every time these capital inflows tended to slow down, they opened the capital account further.
Okay.
That was, in my view, a mistake because what you should have really been doing is the opposite.
Okay. So essentially what you're saying that today government should not put control over outflow of capital.
Right.
Right.
So now having made that mistake, it was, let's say, if we were sitting in July, before the rupee started falling, at that point the rupee had had a real affected appreciation, so the competitiveness of the economy had gone down. Given whatever mistakes etc. were made, we are not going into the details of that, but having made those mistakes, at this point there really was no way out but to let the rupee depreciate to counter that earlier appreciation. Okay. So the mistake was in trying to restrain that depreciation, and it's always hard to judge what exactly that point is, but that point is somewhere below 65. So in effect what I had recommended was to let it go till around 65, and then if you want to introduce any measures, they should have come after that.
Okay, so you are suggesting that 65 to $1 today would seem like a fair,
at this point in time,
appropriate exchange rate.
Somewhere around 65 fully corrects for that loss of the real appreciation, as we call it, by the depreciation. So we have come back to the competitiveness of roughly 2007. Now that doesn't mean if further bad things happen, you may not need to depreciate further, but at this point I would say it's 65 or less.
So you're suggesting that beyond this, the RBI could defend the rupee?
Right, it could have, except for it's kind of lost the confidence. But when a new RBI governor comes in, maybe he can re-establish this confidence.
Okay. Dr. Virmani, now who is to say what will happen to the currency, not only India's currency, the other emerging markets that you mentioned, 8 emerging markets which benefited from huge inflows from the US in 2010, 11, 12. If the Federal Reserve actually starts tapering the monthly support that they are giving to the economy, about $85 billion I'm told, what happens then?
Okay, so when they stop these injections, the markets anticipate a rise in the interest rate in the US, which you can take as a measure of the global interest rates. When global interest rates rise, the market expects that Indian interest rates will also rise. Okay, and that means negative effect on growth. Okay, so depending on the growth projections of the economy, there will be a differential impact on different economies. So when you are talking about those 8 economies where the growth prospects are better, they will have a less of a negative effect. If the growth prospects are better, they'll have a less of an effect. When if they are poor, they will have more of an effect.
Because there's some US respected US analysts and economists are saying that eventually, if the US economy indeed improves and European economy also improves, it will tend to lift the other boats.
Right.
So in India's economy, China, they will actually do better.
So the whole thing is about timing. You see, the initial effect is their expectation. That's right. The initial effect, if the interest rates rise, expectations of higher rates and a negative effect on growth. Okay, in these economies. Okay, so the only way to counter it, just to mention briefly, is reforms which will promote investment and growth.
Okay.
Okay, so leaving that aside for the moment, happens, as I said, is a differential impact. Okay, and those economies which are basically fundamentally stronger have less of an effect.
Okay, less of an effect. We'll take a small break here. Do stay with us.
One of the things I've suggested is a major program of demonopolization of government monopolies to introduce more competition.
Welcome back to State of the Economy. Dr. Virmani, you suggested that if the US economy improves, indeed, interest rates go up. Initially, because of the financial shock, there could be some problems here, but eventually, as growth picks up there, other emerging economies will also benefit. But you suggested that in the meanwhile, India should do the necessary reforms to support that uptick in growth. What kind of reforms?
Absolutely. So remember, when we come to the Indian economy, you got two things going on. One is the external factors which we have discussed, and the internal factors. The internal factor is clearly that the rate of growth, if you draw a trend line on the Indian economic growth rate, it's been going down. If you draw it on the annual data and the quarterly data, the quarterly is even steeper.
We are down to 4.4% GDP.
That's right.
Last
reported
quarter.
Now I'm coming to the longer term growth factors. We've discussed the macro and the exchange rate and all. In the longer term growth factors, the trend has been clear for some time and it's been happening. And even in the last economic survey that I worked on in 2008-9, before I retired and went to the IMF, what I had said, I had drawn up a menu of various reforms. It was in 5 boxes in the economic survey. And what I had said was that most fast-growing economies always make this mistake that growth will continue. They are too optimistic. But my research showed that this is not the way the thing works. Normally countries grow for a little while, then some shock happens, they're unable to deal with it and it slows down.
So this is the history of maybe Brazil in the maybe 70s and all that?
There are 10 countries. Brazil actually was not among the very fast growing economies. There have been about 15. I mean, we can discuss those at some other point.
So you're saying that
but
they get a shock.
The basic point is that it was needed. We needed to gradually do the reforms. That was the basic recommendation. And because we didn't do it, again, we get cornered. If things accumulate, if you keep doing it gradually, it keeps things moving and it stops the trend decline. But anyway, now we are at this stage and the main point I want to make here is what would have been sufficient to keep the growth rate from falling so much 2 or 3 years ago is no longer sufficient. That's why you need much bolder reform. You need to now make a statement that you can do. For example, one of the things I've suggested is a major program of demonopolization of government monopolies to introduce more competition and therefore improve productivity and reduce costs.
But tell me, Dr. Virmani, my study shows that our current account deficit of 4.5% to 2012-13, a good 30-40% of this has occurred because of simple mess up like not exploiting our coal reserves. India has one of the largest coal reserves. And the iron ore mines in Goa and Karnataka, for various reasons, they were shut because of judicial intervention, a lot of illegal mining happening. And for some strange reason, gold imports went up by about $25 billion since 2011. Now, if you aggregate these 3 outlier events, you get a current account deficit of actually less than 3%. So these are not structural issues, right?
Well, yes and no. You see, the thing is,
iron ore mining not happening and coal mining not happening is not a structural issue, right?
Well, it becomes a structural issue because if you don't change it, you won't get mining. So in that sense, it is structural, right? It has to be solved. It's like the land acquisition process. If it grinds to a halt, it becomes structural. You need to solve it. In that case, by a law which doesn't stop land transaction but promotes them.
It's more political in that sense. It's not an economically structural.
Right, but in some sense, every economic issue can become a political issue, right? If you have to have a law or if there's opposition from some party, it can become political. So in that sense, you are right. But the point is that you have to remove the thing. For example, we've had high inflation in agricultural sector. Now you need to sort that, otherwise this high inflation is going to continue and it's going to force you to depreciate further.
Yeah. And another example I want to give you, since you were at the IMF as India's executive director, India bought 200 tons of gold in 2009. Now the point is, at that time, I'm told we
But
bought...
before we run out of time, just one thing which is very difficult for people to understand. There is an external balance which you're talking about, but corresponding to that is an internal balance. And it's very complicated. They interact. So you can't only change the external balance and think everything will adjust. Yes, it will help. The external balance, like what you said about gold, etc. But gold is also an asset. It's a saving. So it has something to do with the internal balance.
I'm on a different point. What I'm saying is that we bought the gold at that time, 2009, mainly thinking that it would be a hedge against the volatility in the dollar, actually. We thought that let's increase our gold...
you're talking about the purchase of gold from the IMF, right?
Now we are in opposite situation where the dollar is not volatile, but the local currency is volatile. So there is a view within among policymakers that gold, people who want to import gold for genuine jewelry making, etc., this gold should be accessed. Do you agree with that?
Well, basically, access means it has to be sold.
Yeah, it can be sold to the local jewelers rather than import fresh gold, right?
But you can't, the whole point is at some point it has to be a dollar, right? So if you're selling it in dollars, then only it will affect the, if you just sell it internally, you're just going to get rupees, right?
No, dollars, because you sell it for
You
dollars.
sell it for dollars, no? Yeah. So the person has to have dollars. So you got to open up this purchase for dollars, right?
They're paying dollars in any case, even now, right? The jewelers, when they import from...
Yeah, but those who are permitted, right? It's channel. As far as I recall, most of it has to come through the banking system.
Yeah.
So in that sense, you have to sell it to the banks who have the dollars.
Through the banks,
right.
This gold can be brought and sold to the jewelers,
In principle, there's nothing wrong with that. I don't have any objection to that. And but you have to remember, that is something you can only do for a certain amount of time, right? And you still got to kind of solve some of the other problems. Sure. Otherwise, you'll be back to the
I'm saying it purely as a short-term fix.
As a short term, I don't see any problem with that.
And finally, do you think the RBI can reduce interest rates now to push growth? Because India's interest rates, short-term rates went up effectively 3% in the last 2 months.
So this is the most complicated, and we have very limited time. The conventional view of the markets, and I hope not of the governor, the new governor, but I suspect he is conventional, is that given that global interest rates are going up, and given that our inflation rate, at least in CPI terms, is still higher than the international CPI, the natural tendency would be to raise interest rates further. In my view, that would be a disaster. What I am suggesting is an unconventional policy which does the opposite. But that can only be carried off. You can only reduce the interest rate if government consumption is also reduced. And that is very difficult. But if you could do it,
fiscal deficit also.
That would have two effects. It would promote growth and it would dampen non-tradable inflation, which is a major factor. Even agriculture is not really a tradable in India because we constrain it. So you could consider agriculture as part of this non-tradable. So if you reduce the subsidies and consumption of the government, that will allow you to lower interest rates and promote investment.
Okay. Thanks a lot for talking to us, Dr. Virmani. That's all we have in this edition of State of the Economy. We'll be back with you next week. Thanks for watching.